Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, in the events-moving markets. Let's get into it. The crypto ETF market has gone from zero to over 50 products in just 2 years. We've got Bitcoin ETFs, Ethereum ETFs, Solana ETFs, XRP ETFs, even Litecoin and Hedera funds hitting the market. Analysts are projecting over 100 additional approvals throughout 2026. But here's the critical point most traders miss. These products are structurally different in ways that directly impact your bottom line. We're talking liquidity gaps, staking yields, custodian concentration risk, and hidden costs that dwarf published expense ratios. Let's break down what actually matters. Bitcoin ETFs launched in January 2024 and set the template for this entire market. Cumulative inflows have exceeded $61.8 billion. BlackRock's IBIT dominates this space with over 800,000 Bitcoin under management, despite charging 0.25%. According to BlackRock's official product data, IBIT commands roughly 3 times the trading volume of all other Bitcoin ETFs combined. That liquidity advantage translates into tighter bid-ask spreads, which means lower transaction costs for active traders. On the opposite end, you've got legacy products like Grayscale's GBTC, still charging 1.5% after converting from trust structure. That's a 600 basis point disadvantage versus the cheapest competitors. The math is simple. A 1.25% annual fee differential on a $100,000 position costs you $1,250 per year in lost returns. Ethereum ETFs launched in July 2024, but faced muted demand initially. The momentum shift happened in May 2025, and by February 2026, total inflows hit $14.48 billion. BlackRock's Ether leads the pack, holding more than 4.01 million ETHs at a 0.25% fee. But here's where it gets interesting. Staking capabilities. Grayscale became the first issuer to integrate staking in October 2025 after Treasury and IRS safe harbor provisions clarified the regulatory landscape. As reported by Dessert and multiple legal sources, the SEC approved in-kind creation and redemption mechanisms on July 29, 2025. This was a game changer for tax efficiency and NAV tracking accuracy. Some Ethereum funds now offer staking yields while others don't, creating a structural performance gap that has nothing to do with management skill. Meanwhile, Grayscale's legacy Ether product still charges 2.5%. That's a punitive fee structure for a product that hasn't kept pace with innovation. If you're holding ETH, you're paying 10 times what the most competitive products charge while potentially missing out on staking rewards. Solana ETFs entered the market in late 2025 after regulatory delays tied to the U.S. government shutdown. According to Invest in ETF Trends reporting, these products launched with staking enabled from day one, offering yields in the 6 to 7% range. That's substantially higher than Ethereum's staking yields. Solana's protocol also includes no slashing mechanisms, which reduces validator risk. Bitwise's BSOL pulled in $56 million in debut day trading volume, signaling strong institutional interest in staking-enabled products. BlackRock isn't in the Solana ETF market, which creates a different competitive dynamic. Without IBIT's liquidity dominance, traders need to pay closer attention to bid-ask spreads and tracking errors. Everstake data shows Solana staking yields have been consistently higher than Ethereum, making these products attractive for investors who want native yield without the operational complexity of running validators. XRP ETFs hit the market after Ripple's complex legal journey concluded. 6 approved spot XRP ETFs are trading with fee structures ranging from 0.19% to 0.75%. Canary Capital has pioneered altcoin ETF offerings for Litecoin and Hedera at premium fee levels around 0.95%. These higher costs reflect the specialized nature of alternative asset exposure. Beyond single asset funds, the market now includes multi-asset crypto index ETFs like the Bitwise 10 Crypto Index and 21 Shares products. These diversified offerings currently manage approximately $1.7 billion with projections to exceed $5 billion by year-end 2026. For investors who want broad crypto exposure without picking individual assets, these funds provide instant diversification. Now let's talk about the risk nobody's pricing in: custodian concentration. Coinbase serves as custodian for more than 80% of U.S. spot crypto ETF assets. According to Bloomberg and Reuters reporting, Coinbase is safeguarding over 2.7 million Bitcoin, worth approximately $261 billion as of February 2026. That's systemic risk. If Coinbase experiences an operational failure, cyber incident, or regulatory action, multiple funds get hit simultaneously. Fidelity represents a notable exception, using proprietary custody systems that mitigate this counterparty concentration risk. Hidden costs beyond expense ratios are where most investors get blindsided. Bloomberg ETF analyst Eric Balchunas has emphasized that bid-ask spreads and tracking error can significantly alter investor returns beyond the sticker price-expense ratio. Invesco's BTCO showed a negative 0.7% tracking error as of December 2025. That means the fund underperformed its benchmark by 70 basis points, completely wiping out any expense ratio advantage it might have had. The in-kind redemption approval on July 29, 2025, addressed long-standing concerns about cash-only redemption structures. As reported by Evershed Sutherland and Morrison Forrester Legal Analysis, this regulatory advancement enhances tax efficiency and reduces transactional costs by enabling more efficient arbitrage mechanisms. In-kind redemptions allow for direct transfer of underlying crypto assets, tightening NAV tracking and reducing tax leakage. Staking capabilities are redefining value propositions across the crypto ETF landscape. Ethereum ETFs initially launched without staking until regulatory clarity emerged in mid-2025. Solana ETFs benefited from staking integration at launch. When you're comparing a non-staking Ethereum ETF charging 0.2% to a staking-enabled product charging 0.25%, but delivering 3 to 4% staking yield, the total return equation flips dramatically. The higher fee product delivers superior net performance through native yield generation. Tax efficiency is another critical differentiator. Crypto ETFs structured as grantor trusts under the Securities Act of 1933 offer tax deferral benefits through IRA and 401k account structures. The in-kind redemption advantage approved in July 2025 helps avoid large taxable events during fund rebalancing. But here's the catch. Investors cannot transfer existing crypto holdings into IRAs. You have to sell your crypto, recognize the gain, then contribute cash to buy the ETF inside the tax-advantaged account. Looking ahead, the market is trending toward broader indexes and multi-asset offerings as over 100 additional products hit the market throughout 2026. Fee wars will intensify, and legacy products charging punitive expense ratios will face redemption pressure. Custodian diversification is becoming a competitive differentiator as concentration risk concerns grow. Regulatory evolution continues reshaping product design. The SEC's shift from cash-only structures to permitting in-kind redemptions demonstrates how quickly the framework is adapting. Future updates may further refine how staking rewards are reported and taxed, creating additional product differentiation opportunities. Bottom line, successful crypto ETF products balance competitive fees, superior liquidity, innovative features like staking, and robust operational infrastructure. BlackRock's IBIT and ETH demonstrate how liquidity dominance can justify mid-tier fees through superior execution quality. Staking-enabled Solana and Ethereum products show how native yield generation creates value beyond expense ratio compression. Legacy products like Grayscale's GBTC and ETH face existential challenges from fee pressure and feature gaps. For traders evaluating crypto ETF exposure, the checklist is clear. First, understand total cost of ownership, including bid-ask spreads and tracking errors, not just expense ratios. Second, assess custodian risk and whether the fund uses Coinbase or alternative custody solutions. Third, evaluate staking capabilities and how they impact net returns after fees. Fourth, consider tax implications based on account structure and in-kind redemption availability. Fifth, analyze liquidity metrics to ensure you can enter and exit positions efficiently. The crypto ETF revolution that started with simple Bitcoin exposure has evolved into a sophisticated ecosystem of specialized products. Each fund targets specific investor needs while navigating the unique challenges of digital asset investment through traditional financial infrastructure. As this market matures throughout 2026, the gap between winners and laggards will widen. Fee optimization, custodian diversification, and regulatory innovation are defining the competitive landscape. Investors who look beyond surface-level comparisons and understand structural differences will capture the value while avoiding the performance drags embedded in inferior products. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.